Well, today we're joined by Joe Masters, Chief Economist at Ernst Young. Thanks very much for joining us. For a couple of quick questions, Joe. We've obviously had a very interesting year economically, and I just wanted to ask you some questions that I tend to get asked a lot by my clients as well, and get your view and perhaps the EY view on what's happening in these particular areas. So the first one is really based around the property market in Australia, which I think has reacted in a different way than many of us expected. So I just wonder if you could share your thoughts on what we've seen happen in terms of property prices, whether you're expecting to see that to continue to happen, or what would be the catalyst for that to either continue or perhaps stop.
Sure. So first up, everyone loves to talk housing, right? It's the subject that stops a nation when the race isn't being raced. So you're right. Typically in a recession, we would expect house prices to fall, and we haven't seen that this time around. House prices are rising across the nation. What's kind of interesting though is we're seeing faster house price appreciation in standalone homes versus apartments, and we're seeing it faster in regional areas than in Sydney and Melbourne. So prices are rising, but there's no one market, and we have seen some shifts kind of under the hood, if you like. Why are they rising? Lots of reasons. The first one though is when we look at it from an economic perspective, there are three key factors that drive the housing market: interest rates, unemployment, and population growth. And I think in COVID, there was this sense of the population growth slowing because we've closed our international borders. We will have the slowest population growth in over 100 years in 2021. So a lot less demand. We also thought households would be hunkering down and, very high unemployment rates and no one wanting to get out there and borrow more money and buy houses. What's actually happened though is population growth has slowed, but we've cut interest rates even further, and that's clearly having an impact. And the labour market's been relatively strong. Unemployment is 6.4%. We thought it might be 15 to 20. So people are actually secure in their jobs. Interest rates are very, very low. They also aren't spending money going overseas on holidays and the likes. They've got a little bit more cash, and we're just seeing this run up in first home buyers, in upgraders, and more recently investors coming back into the market.
And are the investors coming back into the market in those standalone dwellings, or are they coming back into the apartment market?
So it's a little bit more spread than we've seen in the past, where it was very focused in that particularly off-the-plan type sales. So off-the-plan sales are still pretty weak. Now, some of that's related to the economics, some of that's related to a little bit of lack of trust in some of these new developments. So there's a little bit of moving things, but I think from the investor perspective, what we're seeing is a sense of kind of where else do you put your money? Now, maybe I'm going to ask you that question, right? So, you've got an equity market that's roaring, you've got house prices rising, but outside of that, literally, where do you put your money? And in fact, someone just this morning said to me, why would anyone hold bonds? Now, as you know, I hold a few bonds in my portfolio, but it's a good question, right?
Yeah, well, the bottom of an interest rate cycle is not necessarily the place you want to be, is it? But you've got to find alternative places to get yield, and that's pretty difficult in this environment as well. So, well, thank you for that. So my next question is probably somewhat related in terms of perhaps this is partly what's driving that asset price growth and perhaps even other asset price growth in other sectors. But really, ever since the global financial crisis, we've had pretty relaxed and loose monetary policy.
Yes.
And in Australia, it more recently got even more relaxed and even more loose, if we can use that term. So I just wondered what your view is on, what the RBA is currently doing in relation to monetary policy, how that will affect the broader economic outlook, and whether we're actually likely to see any inflation return back into the domestic economy, or now we're getting into bigger questions, but perhaps even internationally, because there's a lot of central banks doing the same thing.
Absolutely. So the RBA's done what it had to do, which is pull every trigger that you've got. So we've now got a cash rate at 0.1. We've instigated yield curve control, quantitative easing, the term funding facility, a range of things. And they all do, I guess they all work to the same objective, right? Which is ensure liquidity through the system. So Economics 101, you need flow of money through your economy, right? It's absolutely critical, and we learnt that in the GFC, and we've done that really well. And it's driven interest rates down. The latest move by the RBA, I think, is really interesting. So they extended their bond buying program for another 6 months, another $100 billion. You know, it's eye-watering numbers.
Huge.
What's really interesting, though, is why they did that. And they really did that because, to your point, other central banks around the world are continuing to ease. And if we don't keep lockstep with them, we'll end up with a currency that is higher than it would have been otherwise, and that dents our export sector. So now it's not so much about the level of interest rates. I mean, they're kind of so low, and even if you halved them, again, you're not kind of getting a big bang for your buck. I always describe it at this point in the cycle, it's a bit like pushing on the bottom of a piece of string. You're not necessarily getting much for it, but there is a currency element. So when we think about what does the RBA do next, if we just look at Australia's economic cycle, we're coming out of this recession faster than we thought. The economy actually looks quite good. I think they'll have, easy policy for a long time. The RBA's changed the way that they talk about policy quite dramatically in the last year. So you might have seen they've now put a definite sort of timeline on rates. Governor Lowe said, we do not expect to increase the cash rate until 2024. He's never put a kind of calendar number on that. And even beyond that, as you unwind some of this unconventional policy. But if other central banks continue to ease, the Bank of England's talking about negative interest rates and told their financial institutions to get ready for that. The US isn't there yet, but I wouldn't say they don't get there. If they get there, we're going to have to continue to do more and more and more.
So how far do you go, and how far can you go?
Yeah, I actually don't think we'll go too much further, but I'm also old enough to know never say never, right?
Yeah.
I mean, we said no QE for a long time, and here we are. But really, to get any further easing on any of those measures will be driven by what happens offshore. Right. So that's what you've got to keep your eye on. Can we generate inflation? We will see a pickup in inflation in the next couple of quarters, partly because some of the government policies are winding off. So things like free childcare, as that came to an end, you get this big blip in headline inflation. Some people believe that we'll get some lift in inflation because we've got pent-up demand and still slightly disrupted supply chains. Mm-hmm. And you're seeing that shipping costs, for example, Shanghai shipping freight costs are 3 times where they were a year ago. So you are seeing a little bit of that. The truth of the matter is the number one determinant of inflation is wage growth. And I don't see any wage growth anytime soon. And therefore I can't see how you get a sustained period of higher inflation.